whenever you're looking at evaluating things, you'll have to evaluate it from all the sides. What doesn't work for both parties will not work for the deal. So that's very important in terms of the mindset with which you are evaluating things. A couple of other things that you must be, mindful of is, one is that wherever there is a payment being made to a non-resident, there is a requirement for the payer to withhold the tax under Section 195 of the Income Tax Act. And this is a sacrosanct requirement. You must evaluate at all points of time what is the capital gain that the party is, receiving, what is the capital gain accruing to the other party, and that ought to be certified by a chartered accountant. And you need to look at whether they have, they have taken all the components appropriately, whether there is evidence for, having incurred the cost, the peripheral cost for, which can be taken as deductible, and also the period of holding. All of that has to be checked, and then you arrive at a computation which gives you the exact capital gains tax amount, and then you kind of withhold the tax. There is a requirement, and the money is remitted from India. There is also a requirement for you to do the compliances under, and file Form 15 CA and CB with the RBI and with the Income Tax Department in order to be able to make the remittance here. The other two key important things that you should be mindful of are the relatively new sections of 194O and 206C1H, which basically says that, if you're transacting in goods, then you may have to withhold or collect a tax of 0.1%. So please always check. They don't operate simultaneously. If 194O is applicable, 206C1H will not apply. But it has to be a mindful application of knowing exactly which section may apply, and then one would need to